How do fund managers value their assets? An industry insider walks us through the process, plus 1,000 pages of new rules to govern your relationship with your financial advisor. We'll break it down in 5 minutes or less. This is 7-Day Yield. Welcome to 7-Day Yield. I'm Mitch Rochelle.
And I'm Haley Zimring, and here's what's trending. The majority of 1,400 U.S. employees polled in a new PwC survey say they believe the 8-hour workday will soon become obsolete. And 68% of those surveyed believe they will be able to get their work done outside of a traditional office. With many, if not all of us, practically glued to our mobile devices, checking in with work and responding to emails at night and on weekends has quickly become a way of life. Interestingly, this study shows that flexibility seems to be the key to keeping workers satisfied, revealing that employees who can work remotely at least one day a week are more likely to say they're happy at work. While Social Security was built to shield elderly Americans from financial woes, about 6.4 million kids, or almost 1 in 10 Americans under the age of 18, now rely on checks from Social Security. The fastest growth is among indirect beneficiaries, especially kids who live with their grandparents who are collecting the federal benefit. The U.S. Census Bureau estimates that Social Security benefit checks make up 39% of household income for underage beneficiaries. Our last trend zeroes in on financial literacy. We all know that knowledge is power when it comes to investing, and a new PwC study shows that millennials are the age group with the lowest level of financial literacy. When tested on financial concepts, only 24% demonstrated financial knowledge, but despite this staggering statistic, only 27% are seeking professional financial advice. So Mitch, it seems financial literacy is all about learning the basics. Why isn't this taught more in grade school?
Teachers really lack the tools to teach financial literacy to kids. They also don't understand the basics themselves, and if you don't have that comfort level as a teacher, you're not going to be able to teach it to kids. So it's all about the basics. Speaking of the basics, I recently sat down with PwC Partner Dan Sullivan, who explained how asset management firms value the assets they manage. Take a listen. Dan, the valuation of assets and funds, whether they be hedge funds or mutual funds, are done at fair value. So maybe you could start with explaining what fair value is.
Yeah, Mitch, fair value is actually pretty straightforward. When you think about it, what is the price that someone would actually pay you to purchase something? So very simply, and it's very important, it's the price someone else would pay you, not what you think it's actually worth. So as long as people would say, yeah, I'll pay you for that, that's basically the equivalent of fair value.
So but let's say a marketable security, a stock, a bond, something with a CUSIP number, if you're a fund manager, is that an easy thing to ascertain on a certain date what the value of an asset is?
Well, typically if something's a marketable security, it should be an easy thing to value. It should be something that you can sell very in short order and you understand exactly what you could sell that for. So if you think about a stock and you can go pull that up on Yahoo Finance and type in the price and see exactly how many shares have traded in the last 5 minutes, that's a common sort of marketable security that you should know what the value is at any point in time.
Even if there's a lot of volatility in the market, staying on the notion of marketable securities, even if there's a lot of volatility, they're still going with your definition of fair value. There's still a price that somebody's willing to pay for that asset, so you can still market at that price at that date, correct?
Yeah, so as long as you're seeing transaction activity, then typically you've got enough information within a small range to be able to say this is probably what that asset is worth. It really gets really interesting when you have a situation where perhaps there is no trading activity or trading activity stops. So sometimes they'll stop trading on a stock that declines significantly, and the question is, where is it going to start trading again? And that's where it gets really interesting to figure out what is the true fair value of a company or of a bond.
And if the cutoff date for valuation for that fund is that Friday, let's say, and there was no trading for several hours towards the close of the market, you don't know what somebody's willing to pay at that point in time. So how would a manager ascertain, they need a value, how would they ascertain the value for that security?
Yeah, well now you're starting to get into the majority of really how financial assets work, which is there has not been a trade on that specific security that anyone can say, well, this is exactly what it's worth. So they have to come up with a way, an expedient to say, well, this is what I think it's worth. And there's a lot of different ways that people can do that. There's a lot of vendors in the marketplace who will take all of these typically bonds and sometimes certain equity instruments, and they'll actually put a price on that every single day using various models and other what we'll call matrix techniques. And they'll actually deliver you that information on a daily basis, and that way hedge fund manager X or mutual fund can take that information and apply it to their portfolio and say this is what each of those assets is worth.
Help our audience understand models. You used that word before. Maybe we can lift the hood up on the engine and see what a model looks like.
So a model can be pretty much anything where you actually have to go sort of calculate the value of a security. You're probably using some form of a model. So it could be something as basic as I own a security that's going to pay me $100 in a month from now. Well, I'm not going to spend $100 to get $100 later. Maybe I'll spend $99 to get $100 later. So the question is, how do I go from 99 to 100? Well, I may present value that $100 to 99. I need to know what is sort of the rate of return. So just that fundamental calculation of saying X times Y is going to equal to my price, that's a model.
So Dan, real quickly as we wrap up, in your role in the oversight of models used in valuation, what do we do to sort of help the marketplace better understand the efficacy of what's in a model?
Well, when you think about models, the first thing you really need to think about is the quality of your inputs, right? And again, going back to that question of what's fair value, it's what someone else would pay for it. So the first thing that we would want to know is, can you source those inputs based on what the market thinks that should be, right? So if I can go out and look at something on a Bloomberg terminal and say, well, this is exactly what the market thinks that the yield on this asset should be in 5 years, well, that's a good piece of data to go put into the model. And for us, we're much more comfortable with that type of information than if fund manager X says, well, to me, it should be this number, right? Because fair value needs to be, what does someone else think it's worth, not what I think it's worth. So your starting point one is, can you find quality inputs into these models? And the higher the quality of the inputs into the model, typically the more narrow the range of what that fair value is likely to be, which is good because then investors and others who see that, they actually have more comfort that if you were actually to sell that security, this is probably the price I could get for it. As you start to step down though into more complex investments where there's not necessarily a good comparable bond or comparable security to say, even though this security I don't know what the price is, this one over here is just like it and I know what the price is there, well then you start to get into a lot more assumptions around performance, right? What's the likelihood that this company is going to be able to be around in 5 years, or they're going to be able to pay all of their debt? What would happen if the economy were to turn sour? How much of an impact would that have? Is this company is it currently being disrupted, and as a result their business model is not working? There's no sort of direct ability to just take that and put it into a model. There's a lot of judgment that has to be applied. And that's really a lot of the secret sauce, is being able to take a lot of that qualitative information and then take that into a singular viewpoint and put that into an estimate of what the likelihood of the performance of that asset is.
And Gary Melcher joins us now. Gary, when you think about the asset management universe, it seems the efficacy of financial models is an area that has the attention of a host of stakeholders.
I think the key point that Dan made at the end of his interview was judgment. Okay, I think what you have is you've got increasing complexity in a number of investments. The valuation or fair valuation requires a lot of judgment. There's an increase in the use of models, inputs that are coming in from various different sources. And the primary stakeholder now that is looking after this really is the regulators. They're ensuring that there's consistency, it's being applied, it's being, the technology and the support around this, the inputs is all working so that this judgment can be, utilized, and then valuations can be appropriate.
And clearly we're trying to help people understand the process, but how well do you think regular investors, and maybe even regulars, really truly understand the valuation process?
You know what's interesting about that? It's not so much that they're stepping in to question, okay, the ultimate value. What they really want to understand is the robustness of the process, okay? Where are the inputs coming from? How are you employing them or deploying them consistently? What type of technology? They're really ensuring consistency, and they want to know source. They're never going to really step in and say the value should have been X or Y. It's what is your process? Does the process support the judgments that you've made? And that's critical.
Great. Well, thank you so much for joining. When we come back, we'll tell you everything you need to know about the Department of Labor's new fiduciary rule. Stay with us.
Your daughter has a brilliant idea for her science project, and you could make it happen, right? Wrong, because you're not you. You're a cancer hospital, and your daughter, she's a team of leading researchers. And that brilliant idea is a breakthrough in patient treatment that could save thousands of lives, which means you need a diverse team of advisors helping you, from research data analytics all the way to transformation of clinical care. So you call PwC, the right people to get the extraordinary done.
Welcome back to 7-Day Yield. I'm Mitch Rochelle. The Department of Labor recently released its fiduciary rule, which is a astounding 1,000 pages. 7-Day Yield senior producer Lydia Morris sat down with Strategy Ann's Arjun Saxena to learn from him what it all means. Take a listen.
Arjun, the Department of Labor recently released the Fiduciary Rule. It's a 1,000+ page document, so could you briefly walk us through what it actually means and what the impact may be on financial advisors?
Sure, absolutely. So the Department of Labor, as many of our listeners probably know, has jurisdiction over how retirement assets are handled by financial advisors, wealth managers, and so on. And what the new regulation does is to raise the standard of care on how wealth managers will be treating their clients going forward to an ERISA fiduciary standard. So it's a significantly higher standard than what was prevalent so far, which was either a suitability standard or a 40 Act fiduciary standard. And essentially what it does is to raise the bar in terms of how wealth managers will be treating their retirement clients going forward. And this has knock-on effects, as you can imagine, on across the industry, right? So asset managers, retirement platform providers, even the technology firms which serve some of them, and so on and so forth.
So with that, are we likely to see some consolidation in the industry in terms of some of the bigger shops acquiring smaller independent firms?
That is likely to be the case. So remember, it's a complex piece of regulation. There's going to be a lot of effort and investment, resourcing that each of the wealth managers, the asset managers too, would have to invest in terms of complying with it. And in order to do that, clearly something like that favors the larger firms which have the resources and can incur the fixed costs and spread them over a larger base, right? So the expectation is that there will be some consolidation. In fact, I think some of it is already underway and is visible in some of the moves by at least some of the players, for example, the insurers, to divest broker-dealers that they previously owned, right? Similarly, some of the smaller players, the players with a mixed investment track record on the asset management side, are likely to face pressure to, essentially end up being consolidated by larger players.
So if we look at fees for a moment, there's been a lot of talk about fee pressures. How does that impact, or what is the knock-on effect to the underlying fund managers in terms of their fee structures and profitability?
Sure. So I think clearly the Department of Labor believes that there should be, match between the services provided by wealth managers and asset managers to their clients and the fees charged. That's one of the very basic tenets of being a fiduciary. And then secondly, there is also a contention on their part that the industry overall has been charging more than they believe is tenable, right? So there will be indirect and direct impact from the regulation. For one, you will find the spread of fees being closer together because firms will be required to essentially be able to prove in a court of law at times that the fees that they're charging are reasonable in relation to the services they're providing, right? Also, what's likely to happen is that many advisors, many wealth managers will move their clients away from actively managed funds towards passively managed funds, which tend to be lower cost in general. So even if fees on a particular product do not face downward pressure, because of the shift in assets away from higher priced products, whether they be actively managed funds or some of the more exotic products like a REIT and so on and so forth, towards lower priced products, there will be in net a reduction in total fees that investors pay.
And if we just, one more question in terms of looking ahead and what's next. Obviously the fiduciary rule right now only covers retirement products. So are we likely to see that expand into all assets?
That's a good question. So, so firstly, remember that in terms of retirement assets, in rollover IRAs alone and related products, it's $7.5 trillion, right? So it's a very large sum, probably the single largest chunk of financial assets that most average Americans have. And going forward, the SEC has already announced that they will be publishing a fiduciary standard of their own at some point. Our expectation right now is that it won't happen in 2017, but certainly in 2018 perhaps. And that will cover the rest of the industry or the rest of the retail wealth management sector, which has not been covered by the DOL rule. So certainly this is a precursor and a sign of things to come, which will entail greater regulation and big change in wealth management.
And Gary Meltzer is still with us. Gary, by the way, you are a self-described 7-day yield binge watcher, by the way. We learned that during that package. There's two terms that are in the DOL rules, best interest and suitability. And I was wondering if you could explain that to the viewers.
I think what they're really getting at, with whether it's best interest, suitability, or even when you talk about fiduciary, is the level of care that you need to exercise with respect to assets that you are going to manage. And I think what the DOL, and potentially, as you heard from Arjun at the end of the interview, down the road with a broader based focus on assets, is a greater focus on, are you really ensuring the appropriateness of the investment at that high standard, right, with your investors? And suitability, care is at a lower level than you are now becoming a fiduciary, which is a legal role that you now play with respect to ensuring the appropriateness of the assets that you're managing.
And we've talked a lot about compensation on 7-day yield. How does this change the compensation structure for financial advisors?
I think that the financial advice model, which we've talked about in a number of our segments, is continuing to change. There's a much more significant focus on longer term performance, fee-based versus transaction-based, getting paid for, kind of the appropriateness of the investments that you're making and the returns that your investors are earning. So we are really getting to, again, alignment with your investors and the asset base.
Well, Gary, we're going to leave it there. Thanks for sort of co-anchoring with us today. And
It's
thank
been
you
fun.
all for watching.
Make sure to follow us on Twitter at the handle below and subscribe to PwC's YouTube page to get our latest episodes. We'll see you next time on 7-Day Yield.